Hey traders, this is Blake Morrow with Trader Summit. It's Friday. I'm with Jim Welsh from Macro Tides. Hey Jim, good to see you, and good week or GDP week to you. I know we're going to talk about that here in a few minutes, but happy Friday to you. And I know it's been a crazy week in the markets. Lots of volatility. Stocks are, the S&P's at 4,100. I have to say you've been calling it pretty keenly. We're going to get into your charts. But what do you make of this week? I mean, let's start off with that. What do you make of the week?
Well, I think first of all, you got to look at Fed policy, what they announced, 75 bips. As you know, I've been saying that for weeks, so no surprise. I also expected in the Monday weekly technical review, I said there's likely going to be a big sharp rally during Powell's press conference because the market is dying to look at any chance that the Fed may not go 75 bips at the September meeting.
So was this a pivot? Did you see his tone, the fact that he said we're coasting in neutral now? Does that mean that he's pivoting? I mean, because if you're using a car analogy, we're in neutral. Right. Are we coasting in neutral? And he's going to slam it into reverse, and then kill the gearbox, and the clutch is ruined. I mean, what do we? Yeah. What do you think?
Well, let's first of all make a point here. The majority of Wall Street has completely bungled, if you will, their analysis of the Fed, as the Fed also, last year was saying transitory inflation, Wall Street was on board, and so forth. I think that they didn't really listen close enough. So to answer your question, was this a pivot? I don't believe so, because Powell reiterated, hey, the dot plots say we're going to 3.4. Now, the rate of the increases are going to slow. And this is a point I've been making for weeks, that I think the Fed is going to downshift in September. However, they need a lot of data points to come in to give them that wiggle room. So I believe the market overreacted to what he said, that it wasn't, if you will, quote unquote, a pivot.
And Jim, I'm gonna tip my hat to you, because I'm gonna be the first one to say that you told us so early on, before the Fed started this campaign. You said the Fed is going to front load rate hikes. A lot of Wall Street was not believing that. And you guys can go back to watching these videos like January, way back earlier this year. That you said they're going to front load, and they did. They did. Now, I mean, some of you could say that, well, the Fed really should have, raised a full basis point, or full percentage point, excuse me, hike after hike. But they did front load, and now they're really in neutral, maybe shifting gears to a slower rate of hikes to get to that 3.4, 3.5%. Is that what you're saying now?
Yeah, no, I mean, that's for weeks. I've been saying, I think what's likely to happen at the September meeting, that they will at least debate it, and they will communicate that before they go into that meeting, that 50 is on the table. Right now, 75 is where they're at, and they need to do that. Again, we're talking about the rate of increasing slowing down. The assumption Wall Street has made is that the Fed's going to raise rates, and by this time next year, they're going to already have been cutting rates once or twice. I think that that's premature. That's all I'm saying. And I think the market is hearing what it wants to hear. I don't think Powell was quite as dovish as the market has responded.
I just heard what I wanted to hear, and I heard you say dovish. So the Fed's dovish. Yep. That's what I just heard.
That's it. If you really pay attention to what he said, he reiterated job one is inflation. We have to really be convinced that it's coming down. We're going to keep raising interest rate. So my point is, I just don't think we're there yet. And the street, I mean, a guy who's a big name on Wall Street came out with a report. This is 1982 all over again. Wait a second. In 1982 August, the U.S. economy was in a really deep recession. So to say that they're pivoting at this point in time, I think is way, way ahead of the curve.
Okay, so we're going to get into your charts, and we're going to talk about us being in a recession. potentially. But before I do that, I need to say this, guys and gals. If you like what Jim does every week exclusively here on Trader Summit, make sure you give him a thumbs up if you're watching on YouTube. Share this if you saw it on social media, whether it's Twitter, on LinkedIn, wherever you had seen this video. Make sure you share it with your followers, your subscribers. I'm sure Jim would really appreciate that. But let's go into some of your charts. The first one you brought to us, Jim, is the Fed funds rate. Let me go ahead and pull that up real quick.
And this makes the point, visually, what I've just been talking about. So if you go back to mid-July, the street was at about 370. I shouldn't say the street. The federal funds market was at 372. Now, again, if we went back a year ago, Blake, the Fed futures were below 2.5, okay, out a year. So my point is, people put so much faith in what the markets are, quote unquote, telling them. I think it's just ridiculous, quite honestly. So anyway, now we've seen that the expectation has dropped, 45 bips, something like that. The FOMC, you can see Powell said something. Oh, immediately the markets dropped the expectation for where the Fed funds rate is going to be. And then after the GDP report came out, even more. And so the talk about a recession feeds into this idea that we're already in a recession. The Fed can't keep raising rates into a recession. And Powell was specifically asked, do you believe we are in a recession? Now, I think it's extraordinarily likely that Powell had that information. It was it was announced the next day. Did the Fed have it? Of course he had it. He really pushed back pretty strong. No, I don't think we're in a recession. He pointed to the labor market, a number of other factors. But yet, because he had 2 quarters in a row, everybody's, we're in a recession, and that's going to force the Fed to pull back. Again, I think they're overreaching in terms of that conclusion. The Fed wanted the economy to slow because they think they're going to reduce demand, and then that'll relieve some of the inflationary pressures. We're not there yet. Okay.
So here's the GDP. Yeah. I mean, mainstream media is going to tell me we're in a recession, so batten down the hatches. But you still are not quite a believer yet. So explain to us what you see.
After the first quarter GDP number came out, Blake, I went through great lengths saying, listen, if you look at the totality of the information, the economy did not contract in the first quarter. The outfit, the National Bureau of Economic Research, which sometime next year, if we go into a recession, they're going to date it, right? I believe there is almost zero chance they will say the recession started in the first quarter. Second quarter, I think that's a distinct possibility. Anyway, so my point is, if you look at the raw data, okay, the economy shrank 1.6 in the first quarter and only 0.9 in the second quarter. And so on the surface, you say, well, gee, the economy rebounded. No, it did not rebound. And you look at things like final sales, it was up 3.7%. This is one of the key things I look at, how much demand was in the economy. So my take is, the economy was not in a recession in the first quarter. It decelerated significantly in the second quarter. Final demand is proof of it. The reason why Q1 was negative was because trade subtracted 3.2%. Well, why is that? It's an accounting measure, Blake. So it's gross domestic product. So the Commerce Department, when it evaluates this stuff, says, okay, how much was produced in the U.S.? And if demand in the U.S. is then fulfilled by stuff coming in via imports, well, that's not domestic production. They subtract it. It is an accounting measure. So if you alleviate that, okay, trade subtracted 3.2, and you look at final sales, come on, give me a break. Inventory dropped a lot. We already kind of knew this was coming between Walmart and Target. As they get inventories more in line with actual demand, and it may take 2 quarters, in other words, by the end of this year, inventory will stop subtracting. Another factor, the economy slowed, in my opinion, significantly in the second quarter. First quarter consumer spending was up 1.8, dropped to 1%. Business investment up 9.7%. It basically was flat. So these are the things that point to me Blake, hey, there was a significant slowdown in the second quarter. But if I'm going to say that, I also have to say, you know what? The economy did not contract in the first quarter. Services, we're seeing that shift away from goods, which I talked about months ago, because people bought a lot of goods, and as the economy reopened, we'd see services, improve. We're seeing that, and then housing. Okay, housing's taking it on the chin. You can see how much it subtracted. The other thing that the NBER looks at as part of the equation of dating a recession is job growth. Normally you don't have 1.5 million jobs created in a quarter. And yes, it's down to 1.2 million, but that's still over 400,000 or almost 400,000, Blake. So again, my only point here, and I'm not trying to pick sides, I just want to look at the data and hopefully provide objective analysis to our viewers. And I'm sorry, the economy did not contract in the first quarter. If you look at the data objectively, it didn't. At the same time, it slowed materially in the second quarter. And I think we're going to see more slowing in the third quarter. So
yeah, I mean, wait till we start getting that jobs data between now and the next Fed meeting in September, right?
Yeah. Now, again, as I pointed out in our call, our conversations, to me, the jobs, the labor data like jobs are at the end of the pipeline. The first thing we want to be looking at is the JOLTS number, job opening labor. How many jobs are there? Because Powell has repeatedly said, hey, we got over 11 million jobs, 6 million people looking for work. That ratio is like the highest ever. So Indeed comes out with more current data. So the first thing employers are going to do is they're going to cut back on how many people they want to hire. That is definitely already happening. Then if the economy continues to slow, they cut back on hours, and then ultimately they lay people off. So the jobs number is really not the thing to be focusing on in this current environment, because Powell has told us he's really looking at job openings. Those have to come down significantly. And until we have proof that they've dropped from over 11 million to me, like to 8 million, 7 million, that's what Powell is looking at.
All right. Well, let's shift it over to the commodity index. What are you looking at here with commodities? Because, you're looking at the Bloomberg Commodity Index. I was just looking at the Reuters Commodity Index. Really, it had a very shallow 24% retracement on the Reuters one, and
this was 23%.
Yeah. So
very similar.
So I mean, usually shallow retracements mean a continuation. And as scary as that is as a consumer, I mean, it is what it is, right? I mean,
right. Not ignoring it or minimizing it.
Yeah. So what do you see here?
Okay. So you, I think, kind of touched on this, Blake, is that, so what I'm looking at is the chart of this index, and I would think Reuters is very similar. We can see the breakout levels that took place during 2021, where the black line shows the prior peaks going back, 4 or 5 years. We got above that. And then the trend line connecting the high back in 2018 to the November 2021 high, because it dropped about, I think almost 10% between that November high and the December low. So to me, that's like another breakout. Lo and behold, look at where it dropped to. Basically came right down to that trend line. So the reason why I bring this up is that Wall Street, again, simplistically said, oh, look at commodity prices are gone down. Inflation is really a rear view mirror issue. And it's just wonderful news. And I don't disagree. Hey, you had a nice decline. But from a chart analysis standpoint, the Bloomberg Commodity Index has 23 different commodities in it. So it's broad-based, I'm sure, just like Reuters. So to me, it's like, okay, until you take out that green trend line and drop below it, we don't have yet confirmation that commodity prices have indeed peaked. And I think it was likely, and we're already seeing it happen, came down to that trend line, you're getting a retracement bounce off that trend line. That may, if that continues in coming weeks, that starts to throw some cold water on, oh gosh, we don't have to worry about inflation anymore. And that may bleed through. I then went through some of the subcomponents of this index, and you can see very quickly what numbers these various commodities have to get below to, again, confirm. And I went, 20-year charts. What levels do they need to close below to confirm a top in each one of those commodities.
Well, I don't see crude getting below 86, but maybe I'm wrong.
Again, until it does, one has to respect that it could bounce to 110. It could bounce to new highs.
Yeah.
We live in a very uncertain environment. So I just think, again, people have jumped to, oh, commodities went down. That means inflation's peaked. And that's really when the story about, hey, a recession, maybe it's already started. Because why would commodities drop so much? And especially copper, Dr. Copper.
Dr. Copper's really rallied quite substantially. You got gold. I know you want to talk about gold in a minute,
Yep.
but let's talk about the S&P. I mean, we're here we are, 4,100. What do we do?
Yep. Okay. Well, as you know, back in mid-June, I thought there was a rally coming a couple of weeks ago. I was like, hey, as long as we hold 37, 39, and although we dipped to 37.22, we didn't close below 37.39. The expectation was a rally up to potentially 4,031. We've exceeded it, obviously, by a decent amount. So I'm open to interpretation in terms of, all right, at a minimum, do I think there's a pullback to 3,900? Likely. Yeah. You can see on the MAC, on the RSI, we're getting pretty, this is a 2-hour chart, so it will continue to climb. We're getting near a high, in my opinion. So I think there's the risk here that the market has jumped. The Fed is, not going to be as aggressive. I think the speeches that the Fed governors and presidents are going to make in the next 2-3 weeks, Blake, are going to be harping on their resolve to bring inflation down, raising interest rates above the neutral level, and even going so far as to risk a recession. That's going to be the message we're going to hear in speeches in the next few weeks. Earnings are going to be marked down further. So again, I think a pullback to at least 3,900 is likely between now and the end of August. That's my bet.
Wow. So I mean, I don't want to hear that, but I'm sure a lot of people don't want to hear that. But so and let me just kind of put 2 and 2 together. As we head into early next week, you probably look to sell any strength that we get early next week. And
I want to see some of the shorter term indicators that I use, 30-minute stuff start to really roll over. We're not there yet. So in the near term, I have to respect that the market could round up to 4150 to 4200. You can see that red trend line going back, several months ago.
Yeah. The
highs we saw above 4150. So is that possible that we could run up that? Yeah. In the current environment, people believe, oh my God, this is like 1982. And the Fed is going to do this, shallow recession. Oh, everything's wonderful. In that kind of environment, momentum, kind of is the dominant feature as we've seen in the last 2 days. One has to respect that before you say, okay, I think such and such. No, I want to wait for this to play out before I would look to go short.
Well, speaking of momentum, we've got, here we've got bonds. I mean, the bond market, has been pretty strong. You've been pretty bullish on TLT.
Yep.
And yields have dropped. They're kind of, breaking a little bit lower. How do you feel about the bond market here?
I think it's going to run some more.
Really?
I think TLT will get above 120. It looks like there could be, since that high at 119.27, like an A, B, C, D, E potentially for a little triangle, and we should have another pop that takes it north of 120. And depending on how that plays out, I'll probably look to lighten up and do some selling there. But I liked TLT mid-June. The trend is up, lower, higher lows, higher highs. And I think we're going to see weaker economic data. And if I'm right about the Fed speeches harping on their fight against inflation, the bond market is going to want to hear that and like it.
Okay, well, I'm a gold bug. Not really. I mean, I own gold, but look, tell me if I'm a gold bug. Tell me I'm right. What are you seeing here with gold?
Right. No, as we've talked really for, I think, 2-3 weeks, my expectation was that we were going to see a bottom put in gold.
Now we did go a little bit lower than you thought originally. I do recall that. So
about $10. I mean, that's no big deal.
It's enough to shake people out. Come on.
Just enough. Traders. Yeah. I mean, I thought it's going to go under 1798. It got down to, I believe, 1781. But the main feature here, Blake, was that the high back in August of 2020 at 2070, which has the number 3 on it, potentially was the top of wave 3. The last 2 years have been nothing than a consolidation correction, ABC, which implies you could see new highs sometime next year. At a minimum, this pattern to me sets up a rally to at least 1850. And last week I talked about the positioning in the futures market. The commercials had cut their shorts, the large specs had cut their longs. So again, the positioning was constructive. And again, I think the rebound we've seen so far is a good first step. And I think
you are not the only one that has said to me this week that they could see all-time highs in gold this week. So that's interesting idea for you, gold bugs. So that's something for you to chew on. Well, what does that mean for the dollar? Because the dollar, we're kind of crapping out here, but it's so weighted to the euro. I mean, are we euro bulls? I know we're going to get into the euro too, but how do you feel about the dollar here?
Well, last week, what I said is the potential for one more new high to a higher high in the dollar had to be respected unless it traded under 105.75. We did that last night. It then snapped back on the inflation news this morning, which came out showing that inflation, right, at least through the end of the second quarter, maybe through July, I have to remember, was pretty stiff in terms of the employment cost index, the PCE, and so forth. The dollar then snapped back and rallied. And would you believe, if you look at like a 30-minute chart, it came right to the underside of that rising trend line from the late May low and then has sold off. So to me, the evidence is mounting that the dollar has indeed put a top in. And I think just looking at this trend line, it'll work its way down towards the 104. And ultimately, I think we could see 102. That may be 3 to 5 months from now, okay? But that to me is the setup. And the euro obviously should benefit because the dollar isn't going to have a pullback, as you pointed out. At 57% of the dollar index, the euro has to help.
Yeah, it sure does. And I can't see it, but that doesn't mean that something dramatically can't change in Europe and Russia. What's happening in commodity prices that are influencing a lot of the Eurozone right now, and inflation too. So, and speaking of the euro, let's go over to your last chart, which is the euro dollar. What do we do?
Okay,
with
the one thing,
the
ECB raised rates from minus 0.5 to 0. The expectation is they're going to keep raising rates. Well, given what Russia is doing with the Nord Stream gas pipeline, cutting to 20%, and now Europe is going to try to have voluntary cutbacks of 15% of natural gas usage. There's going to be economic repercussions in terms of consumer spending, business activity. So to me, it's almost like a fait accompli that they're going to have a recession next year. And I am skeptical, Blake, as to whether they're going to keep tightening rates with that on the horizon. Now, they may go another 25 basis points, but I mean, there's people looking for 1% on the policy rate. So I think there's a potential that, ironically, not being aggressive in the face of all that is positive for the euro, because it means that, okay, they're actually going to try to prevent the economy from tanking further. We live in an upside down world. Okay. So the euro has not overlapped 103.59. That's the low of wave 1. That would provide me more confidence that, hey, the euro has bottomed. And, as I said last week, buy under 99.52 because I thought potentially the dollar would go to a new high. This would drop to a new low. But as I said, really for the last few weeks, I'm looking for a fairly meaningful low in the euro, because I was looking for a high in the dollar index, and things are kind of falling into place. I just don't think we have confirmation yet that has happened. As I said last week, my expectation is I think the euro is going to 107, 108.
All right. Well,
it takes 6 months, but I think that's where we're headed.
That would be something. And it's funny as a trader, it would be unbelievable. But as a trader, it's like, I don't see it.
Yeah.
But that doesn't mean anything. It doesn't. But technically, I think you got to prove to us that the euro is bullish, and it would have to be above 103.50, and so there's still still some room.
Yeah, yeah. And again, you bring up a really, really important point. And I look at this every day as kind of like one step at a time. Is it possible that gold could go to a new? Yeah. At the same time, it needs to do a lot of things right in coming months to increase the probability of that outcome. Right now, my take is 80% or so, it's going to 1850, maybe 1880. Getting above 1880 and especially 1920, those are the other hurdles that gold has to leap over. Yeah. Before I'm like, okay, now the odds are really shifted and we have a higher percentage of going to new highs. The euro is the same way. You need it to do 103.50 and a couple other things. But interesting, as I said, I don't think the ECB is going to be as hawkish. And I think that's a good piece of news for the Eurozone economy that, again, it's upside down. The logic is, well, they're going to raise rates. That's going to help the euro. Not in the current environment.
All right. Well, that's it. It's something to chew on, Jim. And, I'm a big Jim Welsh fan. How do people and traders follow your work closer than just watching us once a week?
Yeah. Macrotides.com. I do a weekly report that goes through fundamentals, the charts and so forth. And then a monthly Macro Tides issue, which looks at the bigger picture and how it works into, if you will, the week-to-week stuff. So macrotides.com.
All right, Jim. Well, thanks for spending your time with us today. Have a great weekend, and we'll see you next week.
You got it, Blake. Thank you.
Hey, traders. Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also, click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.